Ever tried selling something really specific, like a rare comic book? One of those limited editions that only a handful of people would even recognize. It's not exactly a quick and easy transaction, is it? You might spend weeks searching for the right buyer, and even then, you might not get the price you hoped for. Now imagine trying to sell a best-selling novel, something everyone knows and wants. Finding a buyer is a breeze, and you're likely to get a fair price, even if you want to sell quickly. That's the magic of liquidity, the ability to buy or sell something quickly and easily without taking a big hit on the price. Today, we're diving into liquidity in the world of brokerage firms, specifically how a company like Monaxa uses it to your advantage. We're using an excerpt from Monaxa itself as our guide, all about liquidity and the unsung heroes of the financial world. Liquidity providers. And let's be honest, liquidity sounds like a term invented to make finance sound complicated.
It does have a way of doing that, doesn't it? But it's really a simple concept with a huge impact.
Exactly. So how does Monaxa define liquidity in this piece?
They keep it pretty straightforward. Liquidity is how easily you can buy or sell an asset without causing a major shift in the price. Think of it as how quickly you can turn that asset into cash, ideally without losing money in the process.
Okay, that makes sense. But why should I, as an investor, really care about liquidity?
Okay.
It seems like one of those technical terms that only finance people need to worry about.
That's where you'd be wrong. Imagine this is your hard-earned money we're talking about. Liquidity is the key to unlocking your financial goals because it impacts everything from getting a fair price to minimizing those pesky fees.
Okay, you've got my attention. Break it down for me. Why is liquidity so crucial for someone like me who's trying to make smart investment decisions?
It boils down to 4 key benefits. First up, fair pricing. In a market with high liquidity, you're more likely to buy or sell at a price that reflects its true value. Think of it as getting the best deal possible because there are plenty of buyers and sellers ready to make a move.
So it's like a bustling marketplace versus a deserted street. More competition means better prices.
Exactly. And that ties into the second benefit, lower costs. In a liquid market, the difference between the buying and selling price, also known as the spread, is much smaller. That means you keep more of your profits. Who doesn't love that?
Makes sense. No one wants to see their returns eaten up by fees.
What
What else do we have? The third benefit you mentioned is stability. What's the connection between liquidity and a smoother ride for my investments?
Think of it this way. In a liquid market, there are always plenty of buyers and sellers ready to jump in. This means that even if some bad news spooks a few investors, their hasty selling won't cause a dramatic price drop. There are enough other investors around to buy those dips, keeping the market relatively stable. It's like having a safety net for your investments.
That makes a lot of sense. I'd much rather have a smoother ride than be on an emotional roller coaster every time the market hiccups. What's the final benefit?
The fourth benefit is confidence. Knowing you can easily buy or sell an asset without causing major price disruptions gives you the confidence to make decisions that align with your investment goals. You're not going to be stuck holding on to an investment you no longer believe in simply because you can't find a buyer.
Confidence is key in the investing world. We don't want to feel stuck with an asset we can't easily offload. But all of this depends on having enough buyers and sellers in the market, which is where liquidity providers come in, right? They're the ones ensuring there's always someone to trade with. Can you tell me more about how they actually make that happen?
Absolutely. Remember that analogy of the bustling marketplace? Liquidity providers are like the experienced vendors who always have goods to buy and sell, ensuring the market keeps humming. They're constantly analyzing market data, identifying opportunities to buy or sell, and quoting prices to ensure there's always a counterparty for your trades. Without them, you could be stuck waiting ages for a buyer or seller, especially for less popular assets.
So it's like they're the oil in the engine, keeping everything running smoothly. They're taking on some risk, though, right? I mean, they're always willing to buy or sell, even if the market is volatile.
That's exactly right. Liquidity providers are essentially taking on some risk by always being ready to buy or sell, which is why their role is so crucial for a healthy market. And it's also why it's important for brokerage firms like Monaxa to choose their liquidity providers carefully.
That makes sense. They're entrusting these providers with their clients' money and the smooth functioning of their trading platform. So how does Monaxa ensure they're working with the best in the business?
Well, according to this source, Monaxa emphasizes their rigorous selection process for liquidity providers. They look for providers with a proven track record of stability, financial strength, and ethical practices. After all, they're not just looking out for themselves, they want to ensure their clients, like you, have the best possible trading experience.
Okay, so Monaxa is doing its due diligence to choose reliable liquidity providers. But how does that benefit me as a potential investor? What difference does it make for my actual trading experience?
That's a great question. Let's connect this back to your portfolio. Monaxa highlights 5 key benefits they gain by working with these top-tier liquidity providers, and those benefits trickle down to you as an investor.
Hit me with the top 5. I'm ready to hear how this impacts my bottom line.
Number 1, and this is a big one for anyone who's ever been frustrated with slow trades, is fast order execution. With strong liquidity providers backing them up, Monaxa can ensure your trades go through quickly and efficiently.
No more watching the clock, wondering when my order will be filled. That's a win in my book. What else?
And since we talked about those pesky fees earlier, benefit number 2 is reduced spreads. Remember, tighter spreads mean you keep more of your profits.
More money in my pocket.
Okay.
I'm liking where this is going. What's next? Next up is risk management. We talked about how liquidity providers take on some risk, but they actually help reduce risk for investors too, right?
Exactly. By ensuring a smoother flow of trades, liquidity providers help Monaxa manage market volatility, which makes your investment safer. Think of it like shock absorbers on a bumpy road. Liquidity providers smooth out the bumps and make for a less jarring ride.
Okay, so less risk and smoother sailing, that's definitely a plus. What's the fourth benefit?
The fourth benefit is deeper market depth. This essentially means there's more volume of buy and sell orders available in the market thanks to the liquidity providers. This allows you to trade larger amounts without drastically impacting the asset's price. It's like the difference between dipping your toe in a small pool versus diving into a vast ocean. You've got more room to move without making a huge splash.
I like that analogy. More room to maneuver without disrupting the market. That makes sense. So what's the fifth and final benefit Monaxa highlights?
The fifth benefit is one that really excites me personally, access to new and emerging markets, because liquidity providers are willing to enter new markets and support the trading of newer, less established assets. Monaxa can offer its clients a wider range of investment opportunities. It opens up possibilities to diversify your portfolio and potentially tap into exciting new growth areas.
That's huge. It's like having a front row seat to the next big thing in the investing world.
Okay.
So to recap, thanks to Monaxa's emphasis on strong liquidity providers, I get faster trades, lower costs, a more stable investment environment, the ability to make larger trades, and access to a wider array of investment opportunities. It sounds like liquidity providers are the unsung heroes of a seamless investing experience.
They really are. But it brings up a crucial point. This all hinges on Monaxa choosing the right liquidity providers. And as informed investors, it's not enough to just take their word for it. We should understand how to evaluate liquidity ourselves right.
That's a great point. It's like choosing a restaurant. You wouldn't just blindly trust a friend's recommendation without checking the menu and maybe a few reviews right. So how can we, as individual investors, assess the liquidity of a market or a specific asset? What should we be looking for?
You're thinking along the right lines. Just like you wouldn't blindly trust a restaurant recommendation, you shouldn't solely depend on a brokerage firm's claims about liquidity. You can start by looking at factors like the trading volume of the asset. The higher the volume, the more liquid the market generally is. It's a simple supply and demand dynamic.
That makes sense. Higher demand usually means a more active market, making it easier to buy or sell. What else should we consider?
Another key indicator is the bid-ask spread, that difference between the buying and selling price we discussed earlier. A narrower spread generally indicates higher liquidity, as it suggests there are plenty of buyers and sellers willing to trade at prices close to the current market value.
So a narrower spread means less slippage, less difference between the price I expect to pay or receive and the price the trade actually executes at. What other tools can help us gauge liquidity?
You can also research the number of market makers involved in facilitating trades for a particular asset. More market makers generally mean greater competition and, you guessed it, higher liquidity.
This is really helpful information. So it's about being proactive, looking beyond the surface, and considering factors like trading volume, bid-ask spreads, and the number of market makers to get a better sense of a market's liquidity. It's about empowering ourselves to make informed investment decisions.
Exactly. It's about understanding that while liquidity might seem like a technicality, it plays a crucial role in shaping your overall investment experience. And remember, knowledge is power, especially in the world of finance.
Absolutely. And on that note, to our listeners out there, we hope this deep dive has shed some light on the importance of liquidity and given you some practical tools to navigate the markets more confidently.
We encourage you to keep exploring, keep asking questions, and remember, liquidity is your friend.